Okay, well, thank you everyone so much for joining us today for another Virtual Members Forum webinar. We're really pleased to have you back and to be introducing to you Ian Lee from Merkle Science. Ian Lee is part of the founding team at Merkle Science and led its investigations team before taking over as Director of Partnerships, as well as heading up Merkle Science's APAC operations. A Singapore qualified lawyer, Ian has previously worked in capital markets industry, where he actively advised corporates for listings and corporate actions. Ian was recently named FinTech Leader Under 30 by Singapore FinTech Association, and also serves as VP of Institute of Blockchain, a Skills Future accredited social enterprise focusing on blockchain education and certification. He sits on the ISO TC 307 Blockchain and DLT Standards Technical Committee and is part of the founding team of the Compliance Association and Network of Singapore. As part of his role in Merkle Science and Institute of Blockchain, Ian regularly conducts training on the topic of crypto compliance and crypto forensics for regulators, law enforcement, and corporate enterprises. Ian is a regular speaker at blockchain conferences, especially on the topics of crypto compliance and AML, CFT, and regulation. We're really excited to have him here today, especially at such an important time for blockchain analytics and sanctions compliance on a global scale. Ian, over to you.
Thank you very much for the introduction, Anastasia. And thank you everybody for attending today's session. I'm very excited to be here. And thank you as well to GBBC for inviting me down to share about the work that we've been doing here at Merkle. Just to build upon what Anastasia has said, Merkle Science is a next generation predictive cryptocurrency risk and intelligence platform. And it is our goal to help crypto companies, financial institutions, government agencies detect, investigate, and prevent the illegal use of cryptocurrencies. As introduced by Anastasia, I'm very proud to say that I'm the founding team here at Merkle Science, where today I head up the partnerships division. Now, today I want to be talking to everybody about a very important topic, which is blockchain monitoring. Specifically, I want to introduce everybody to how crypto transaction monitoring has evolved and how today, using the data that blockchain provides, we can enhance the way that transaction monitoring is done through the use of advanced behavior analytics. But why is this an important problem today? Well, this is an important problem today precisely because of the rise in interest in cryptocurrencies. Everybody on the call, I'm pretty sure somebody or someone who's involved in the cryptocurrency space. And that's not surprising because in the last year, we've seen a stark increase in interest in blockchain and cryptocurrency with not just retail users, not just institutions, but unfortunately, we've also seen an increase in how criminals are turning to cryptocurrency as a means to launder their funds. And it's precisely because of this increase in criminal activity that has caused financial institutions, government agencies, and law enforcement around the world concern. And so it's unsurprising then that we see today tons of enforcement action taken by regulators and law enforcement officers against these cryptocurrency businesses that are not complying with the regulatory requirements and standards imposed upon them. And so we see companies hit by large fines by the SEC over in the US, FCA in the UK, as well as MAS here in Singapore. Now, with the rise in crypto crime, regulators around the world have then introduced new licensing frameworks, new compliance frameworks that govern how these crypto businesses are to operate. And as part of this new licensing framework and recognizing that blockchain is a new technology that poses new risk, there's then led to this introduction of blockchain analytics, which is essentially companies that analyze blockchain data and transactions in order to build enhanced monitoring and anti-money laundering systems. So in today's session, I'm going to be introducing firstly to everybody what blockchain monitoring is and how it has evolved over time. So blockchain monitoring. Well, for the benefit of those of you on the call who may be less familiar with blockchain and cryptocurrency, I want to first maybe just spend 1 or 2 minutes kind of explaining what it is that everybody's seeing in front of me. Now, very simply put, blockchain is what we call a distributed ledger. right? It's a way of recording information. And what's unique about the blockchain is that every time transactions are being conducted, these transactions are recorded in this public database, which is the blockchain itself. And what that means is every time a Bitcoin transaction and Ethereum transaction happens, information about that transaction, who the sender, who the receiver, the dollar amount, date, and time of that transaction is made freely available. And so what you see in front of you right now is an example of blockchain transactions being mapped across different accounts, where each one of these circles represents what we call a cryptocurrency wallet, and the arrows actually will show the directional flows as well as the dollar amounts. Now, blockchain monitoring was introduced around 2015, and it was really came about after a very large and well-known hack took place, which is also known as the Mt. Gox hack. Now, for those of you who've been in the space for some time, you probably are familiar with that. It was the largest hack that happened in the past, where there were billions of dollars worth of cryptocurrencies stolen. And as you can imagine, with such a large amount of assets stolen, law enforcement was struggling to figure out how could they go about tracking and identifying the bad actors behind the incident. And so what law enforcement did was they engaged the help of industry experts in order to build a solution to track all these cryptocurrency transactions in real time. And that's how blockchain monitoring came about. It was used to solve the Mt. Gox hack. Now, I want to just jump into a tool right now to kind of let everybody fully appreciate just how transparent the blockchain is and just how much visibility anybody can see in two transactions as they're conducted. Now, what you're looking at right now is actually a graph that maps out a recent hack that happened with the Harmony dApp, right? Now, what the bad actors probably didn't know was that because they utilized blockchain in order to launder the stolen assets, the moment they had misappropriated the assets and started moving it into their own wallets with the goal of laundering it through different accounts and cashing it out, law enforcement, blockchain analytic firms, and in fact, anybody on the call with an internet connection could actually go online and see in real time how these criminals were moving their funds. And so in front of me, we can see how the hack originated from this wallet on the left, where the criminals then proceeded to split the funds into 5 different wallets, which were then split further into 3 wallets each, before having all the funds funneled into Tornado Cash, which is a very well-known cryptocurrency mixer and tumbler service. But as you can see over here, despite the fact that they took efforts to try and move their funds into different wallets, all of this could be seen and tracked in real time in order to identify that it was consolidated into Tornado Cash. And so the visibility that blockchain is bringing into the transaction monitoring space is unparalleled because of the data that the blockchain provides. So this was blockchain monitoring in its initial stages. It was used to help law enforcement solve crime. Now, the way that this was done then would be that blockchain analytic firms would employ large teams of data analysts whose sole job would be to go out there and investigate how criminals were using cryptocurrency, as well as how cryptocurrency businesses like exchanges were storing their funds. And what companies would then do would be to build extensive databases of cryptocurrency addresses, which they've attributed to cryptocurrency exchanges, service providers, as well as a list of negative addresses or bad addresses, which are linked to things like ransomware addresses, darknet marketplaces, as well as even sanctioned. Now, this is not unlike, how today governments maintain a sanctioned name list of criminals, right? Whereas today, with the introduction of cryptocurrencies and the rise in criminal use of it, we've started seeing government agencies like the US OFAC build upon their traditional sanction list to include cryptocurrency wallet addresses. Now, this was all good and effective in the early days of cryptocurrency and blockchain, when most of the users of blockchains, This was very effective in the early days of cryptocurrency monitoring when there were only a handful of blockchain available that was being used, right? So Bitcoin is the first blockchain created. Shortly after, there was a couple of others, with Ethereum being one of the most popular. And so in the early days, most cryptocurrency transaction volumes concentrated on both Bitcoin and Ethereum. And so having a database of good and bad Bitcoin and Ethereum addresses was very effective at helping businesses guard against illicit activity. Because by tapping onto these databases, anytime their clients were transacting with them, they could very quickly compare the wallet address, which was sending the funds, with these known databases in order to identify if their client was sending them illicit funds. Now, the problem with this approach, though, is that in today's world, we don't just see people using Bitcoin and Ethereum, but in fact, there are dozens of popular blockchains in existence, right? We see the rise of Binance Smart Chain, Stellar, Ripple, Cardano, to name a few, right? And there are many more being created annually. And the problem that blockchain monitoring providers have then is that every time a new blockchain is created, it comes and brings with it its own unique data set, which means all the effort in collecting the good and bad addresses for Bitcoin are no longer relevant to, let's say, EOS or Ripple, right? Because it's an entire new blockchain with an entire new data set. And so the problem that blockchain analytic firms suffered from was that the systems that they had built were no longer effective for these newly created blockchains because their databases couldn't be applied onto it. On top of that, as cryptocurrencies became more and more popular, what we started seeing was that criminals themselves were also wising up to how blockchains could be monitored, right? And one of the things that criminals have started doing is that they have started to learn that, hey, I don't need to use my same Bitcoin wallet more than once, right? Because, for those of you who've tried it before, you would be aware that it is absolutely free for anyone to create a cryptocurrency wallet, right? Anyone on the call today, you, me, we can create as many Bitcoin wallets, as many Ethereum wallets as we want, and it's absolutely free. Now, this becomes a huge problem because as criminals start wising up that, hey, I can create as many Bitcoin wallets as I want, I can choose to use it just once and dispose of it, what that means is relying on a database approach in order to flag risk was again becoming ineffective, right? Because criminals would simply use their wallet once and then dispose of it, which means that even though that wallet may have been captured on a database, it would never be used again. Now, recognizing all these problems, here at Merkle Science, when we entered this space, the first thing that we wanted to solve was this question of, well, recognizing that new blockchains are being created, recognizing that criminals are wising up and learning that they can use disposable wallets, how can we still build an effective transaction monitoring system to detect potentially criminal wallets that are not listed on a criminal database? Or how can we perform risk assessment on newly created wallets that may not have interacted with wallets on a database? Now, this problem was actually not that difficult to solve because if you think of it, this is a problem that today traditional banks and payment companies have had to solve already, right? Put yourselves in the shoes of a bank that is dealing with retail customers. If a retail customer goes into the bank today and does a deposit, oftentimes the bank has no way of identifying where those funds have come from. In the event that the deposit is large enough, the bank may request for the client to provide evidence as to where the funds came from, right? So if you're depositing a large sum and you're stating that you obtained those funds by selling your house, the bank may then request for additional information to prove that the funds really came from the sale of your property. But that's all that they can do. So recognizing the limitations as to the data that banks have, the way that banks have been doing transaction monitoring has always been a combination of not just trying to identify where their clients are sending their monies from, but they've also, for the longest time, been deploying what we call behavior analytics, where these banks have systems to monitor for suspicious transaction behavior, right? By applying rules that may trigger whenever customers are transacting in a way that's unusual or may indicate potential money laundering, right? To give you guys a very, very simple example, those of you with credit cards who like to, shop with it, who like to, shop so much that sometimes you overspend your limit. Well, sometimes, you guys may remember receiving an SMS or an email from your bank saying, hey, we've suspended your account because we've noticed some unusual suspicious behavior, right? And that's because, again, they have systems that monitor their customers' transaction behavior in order to detect if something unusual is happening, or to detect if the way that the client is moving their funds is in line with how criminals typically launder their funds. So this is how traditional transaction monitoring was done. And it was very surprising to us here at Merkle Science when we entered into the market that when we realized that, hey, all these companies that were using blockchain monitoring services, those solutions could only identify where the funds were coming from, but none of the solutions were actually employing behavior analytics. And the more that we thought about it, we realized that, hey, this is a way for us to solve the problem of how can we do risk assessment on newly created wallets or on newly created blockchains, because a behavior analytic approach doesn't rely on the database and would be applicable even on these new blockchains. And so the way that blockchain monitoring has evolved today is a hybrid approach, where the database is still important because relying on the database allows law enforcement to identify where these criminals are cashing out their funds, so as to be able to work with those exchanges who hopefully had done KYC in order to tie a real-world identity to the bad actors. But recognizing the limitations of that database approach, it is also all the more important that there is a behavior analytic approach that is overlaid on top of it in order to capture instances where the database may not be enough. On top of that, the way that regulations have evolved today has made it very clear that cryptocurrency businesses and compliance officers cannot ignore behavior. Right. Most recently in 2020, the Financial Action Task Force, which is basically the global AML body, anti-money laundering body, came up with a document called the FATF Virtual Asset Red Flag Indicators, which stipulated a bunch of examples of different suspicious transactions which they expect cryptocurrency businesses to be able to detect. And in that documentation, they made it very clear that as much as it's important for you to detect if funds are coming from an illicit actor, sanctions, darknet, and so on, it is also important for you to be able to detect things like abnormal size of transactions, abnormal frequency of transactions, such as when a client could be structuring their deposit in small amounts in order to, so as not to trigger reporting thresholds, or when you have clients who are perhaps making multiple high-value transactions in a short period of time. Similarly, regulators around the world, MAS in Singapore, FinCEN in the US, FCA in the UK, have all come up with different guidances as to how crypto businesses should implement effective transaction monitoring. Now, here at Merkle Science, what we've then built is a proprietary rule engine that allows crypto businesses to basically customize different rules to detect a range of different suspicious transaction behavior. And the way that we've designed our platform is that we recognize that regulators today around the world are still struggling to figure out how to effectively come up with frameworks. And so because of that, we see regulators around the world constantly updating the requirements. And recognizing that, we thought that it was very important that the system that we built be highly customizable and jurisdiction agnostic, such that compliance officers using our systems can very easily create rules to meet their ever-changing regulatory requirements. So in front of you, what you're seeing over here is the rule engine that we've created with a bunch of different rules that I've deployed. And the way that we've designed the system is that it's very easy to use. In the event that a compliance officer, sees that a new regulatory requirement has been put up, or if in the course of their business, they've identified a suspicious manner that, they've observed multiple of their clients conducting, they can very easily create a bespoke rule in order to detect that behavior. So let me give you an example of how something like that would work. Let's use, for example, this red flag indicator highlighted by the FATF, right? Which is where a client may be structuring their virtual asset transactions in small amounts, such as to keep below reporting thresholds. What compliance officers could then do would be to create a rule, give it a name. So it could be transactions just below reporting thresholds. They could assign a risk level to it that's commensurate with how they want to treat this alert. And then it's a simple matter of creating a rule to detect this behavior, right? So a very simple example could be something like this. Oh, sorry, wrong rule. This one, yeah. They could basically create a simple rule that says, if an address has sent payments in total of at least $1,000 in, let's say, the past 24 hours, right? Because in certain jurisdictions, any transactions, cumulative more than $10,000 in a 24-hour period would require reporting to the authorities, right? Now, the way that we've designed the system is that we recognize that these reporting thresholds may be different in different geographies. And so we wanted to give compliance officers and users of the platform absolute flexibility to decide what these dollar values are, as well as what the look back time period that is relevant to them will be. So that's just one simple example of how behavior analytics can be used to meet your jurisdictional requirements. And this is an example of a FATF advisory document, which again stipulates the importance of virtual asset service providers relying on behavior analytics. And so today, the features of an ideal crypto compliance solution would encompass the ability to monitor crypto transactions, track and identify a range of different suspicious transaction patterns, as well as to identify the source and destination of funds. Now, what I've just talked about, to be honest, is nothing groundbreaking, right? All I've mentioned is that, hey, blockchain monitoring used to be focused on identifying source of funds, but today blockchain monitoring solutions have decided to implement the traditional way of behavior analytics onto blockchain monitoring, right? So this doesn't seem like anything new. Why are we doing an entire presentation on this, right? Is Ian here just to waste my time? Well, hopefully not. What really makes behavior analytics so exciting in the blockchain context is that going back to what we saw over here, in a traditional banking environment, a bank may have only visibility into who the sender and the receiver is. And so their application of behavior analytics is typically only limited to the transactions that they have visibility over. But today, using blockchain, we now have access to so much more data, which also means that we can design more sophisticated behavior analytics systems to detect behavior across, a multitude of accounts in order to identify if all the interactions between them could indicate potential money laundering behavior. On top of that, behavior analytics can also be used to identify cryptocurrency wallets, which are potentially used by criminals for different criminal activity. And I'm going to be showing you guys an example right now. So one example that I love to use for presentation because it always wakes people up is this sextortion example, right? For those of you who are unfamiliar with the term sextortion, sextortion is basically, when, as you can see in front of me in this email example, where the victim is basically contacted by an unknown person who alleges that, hey, we've managed to successfully install a recording device which has tapped onto your webcam and has recorded you basically, visiting, pornographic sites and pleasuring yourself. They would then allege to the victim that if the victim refuses to pay them a ransom of usually between $700 to $1,000, they will then proceed to circulate that video of the victim pleasuring himself to his entire email contact list. Now, as you can imagine, if this was true, nobody would want that video of themselves circulating, right? And so the sad reality is a lot of people have fallen victim to this sextortion scam. Now, why do I say it's a scam? In our analysis of these sextortion cases, we've basically come to the conclusion that a lot of these cases share common characteristics. And some of these characteristics are as follows. Number one, the first thing that we observe is that oftentimes the address that is provided inside the sextortion email is the same across many, many different victims. And this is especially pertinent to take note of. And the reason is because, well, if the sextortion case was real, then by right, the person behind the incident should be generating a unique cryptocurrency account for every one of his victims. Because if he has all the victims paying into the same account, then he has no way of tracking who was the one that made payment, which also means that he has no way of punishing those that did not make payment. So the fact that he uses the same wallet means that he has no intention of actually following through on his threat because he has no way of knowing who paid and who did not pay. Other common characteristics that we noticed was the fact that the amounts asked by these sextortion organizations were typically in the range of $700 to $1,000. They would typically receive a large number of deposits of similar amounts, as well as after they've received the amounts, the funds would then commonly transact with newly created addresses, which is unsurprising if you remember what I mentioned at the start of the call, which is that criminals are starting to wise up, right? That they can easily create as many new wallets as they want, and they can move those stolen funds into a new wallet in an attempt to hide provenance, right? Or an attempt to hide where those funds really came from. Now, recognizing that sextortion scams have these various characteristics, what that means for compliance officers who suspect that, hey, their users have fallen victims to these scams, they can essentially build a comprehensive behavior matrix in order to detect wallets that meet these characteristics, right? So for example, they could create a behavior matrix that looks at if an address is receiving payments from an abnormally large number of counterparties. Because if you think about it, any retail user on an exchange, unless he's a high frequency trader, wouldn't typically be transacting with so many counterparties, right? Even myself, I've been in the crypto space for 5-6 years, and I only have maybe 10 different cryptocurrency wallets. And so anybody that's receiving deposits from so many counterparties is typically, either a business or conducting some kind of operation or a high frequency trader. We can combine this rule with another behavior alert that looks at whether or not this address has transacted in amounts between the ranges of 700 and 1,000. If this address has sent or received at least 20 transactions of above $700 in a specific period. And then finally, if this address also has a history of transacting with freshly created wallet addresses. And the more behavior rules get pieced together to form a matrix, the more accurate its ability to detect for such sextortion examples will be. And again, the way that we've designed the system is that we recognize that criminals are constantly evolving their methodologies, and we may not always be best placed to create rules for our clients. And so we've designed a system that allows, again, the users of the platform to freely create these rules and piece together, different examples of money laundering or criminal methodologies that they observe for their business. Now, on top of that, behavior analytics can also be used to solve other problems, right? Another big issue that not just compliance officers, but law enforcement officers face is that although blockchain is great in the sense that it provides you with an endless amount of data as to where funds are coming from a compliance and investigative officer's perspective, having too much data can sometimes be an issue, right? Because if you think about it, if a bank is serving a client who walks in with cash and the bank can only question that client as to where the funds have come from, then the bank's analysis basically stops there. Where it gets tricky though, is that because the blockchain is so transparent and so traceable, imagine for a second that this entity on the right is the bank, and he's receiving CBDCs from a client, right? Central bank cryptocurrencies, which is built on the blockchain. If funds are transacted on the blockchain, what that means is that the receiver organization of those funds no longer have an excuse to say, hey, this is all I can see, and this is why my analysis is going to end here. With blockchain, users now have full transparency to be able to see where their client received their money from, where the account who sent his client's money received from, and so on, right? And the ability to trace back has no restrictions. Now, this is, again, both a good and bad thing, right? On the good side, it means that there is so much data that compliance officers and law enforcement can use to perform better analytics. But on the flip side, it's a problem because there is so much data that they have to go through in order to do their assessment. And so one of the biggest problems that the industry faces is this question of how far back should the analysis be conducted, right? Should, officers conduct analysis at what we call 1 degree or 1 hop, as what the industry calls it? Should analysis be done up to 2 hops, 3 hops, 4 hops, 5 hops, 6, 7, 1,000, right? Because the blockchain does have the capability to show you as far back as you want. And regulators themselves struggle with this issue, right? Because, if they were to come out and say in their regulatory documents that, hey, we expect all crypto businesses to screen up to 5 hops, well, guess what? Criminals are going to read that documentation and they're going to start funneling their money through at least 6 or 7 wallets before moving it into business to be safe, right? And so the problem that the industry solves is when looking at the source of funds analysis, how far back or forward should one analyze? Or like I said, it's how the industry calls it, how many hops should blockchain monitoring tools analyze? And the reality to this question is that there is no good answer, right? If you ask law enforcement officers, they'll tell you they will go as far back as necessary, right? Which means there is no hard and fast rule. They will just keep going back until they find information that is relevant for them. Now, this approach obviously doesn't work very well for compliance officers, right? If every compliance officer was forced to screen through an unlimited number of hops, then simply by virtue of the fact that, Bitcoin has been around since 2009, and a lot of these Bitcoin have passed through, thousands of different wallets, what that means is that there's a possibility that almost every single Bitcoin has been tainted by a criminal wallet at some point or another. And so the number of false positives goes up tremendously for a lot of these compliance officers who do not limit how far back they look. And to be honest, regulators are not unreasonable. They don't expect businesses to go back as far to when the coin might have been first minted, but they expect businesses to be able to come up with an approach to justify why they may stop at, let's say, 5 or 4 hops. And this is where behavior analytics can come in to provide a solution. Now, one of the things to take note about how criminals move their funds through multiple wallets is that usually these transactions happen in a very short period of time, which means that from the time when the hacker had misappropriated the funds from Harmony to the point where they moved the funds into Tornado Cash, which is a well-known mixer, All of this usually happens in a span of minutes or hours, right? Because they want to move their money and cash it out as fast as possible before, investigators catch on and before investigators, perhaps contact businesses to freeze those funds. And so if you look at the date and time of these transactions, from when funds were stolen from Harmony and moved into the criminal's first wallet, this transaction took place July 1st, 2022 at 12:12 a.m. Shortly after the funds went into this wallet, and if we look at the transactions conducted by this wallet, you'll notice very quickly that immediately after receiving the funds from the Harmony wallet, which again took place at 12:12, within a span of just 10 minutes, the hacker had then moved all the funds into a series of these 3 wallets, right? And similarly, in a span of a few minutes, he then moved the funds into Tornado Cash, which means that this entire process of moving the funds through these 2 intermediary wallets happened again in a span of minutes. And this is very common behavior by a lot of these bad actors. And if I can recognize this, then what it means is that we can build a rule to detect when criminals are potentially money laundering in this manner. And the way that such a rule would work is something that we call transit address detection, right? Which means that it's an address that processes a deposit and withdrawal in a short period of time, which probably served no economic purpose. And so the behavior rule that would detect for such activity may look something like this. If an address has received payment in a short period of time and has withdrawn at least 90% since, right? So funds came in and the bulk of it went out in a short period of time. Now we can combine this with another rule to make it even more powerful, right? Which is that not only did this address receive payment in a short period of time and withdrawn most of it, but the funds were also withdrawn into a newly created wallet, right? Because again, this is very common methodology by criminals who want to move their funds into new wallets because they recognize that those new wallets would be on no blockchain analytic or government database, right? But what they may not fully appreciate is that with the transparent nature of blockchain, it doesn't matter how many new wallets they move it into, we can trace through all those transit addresses in order to identify where the funds really originated from. And with a rule like this, compliance officers can more quickly detect instances which may warrant them to trace beyond their typical 5, 6, 7 hop. Now, on top of that, we can evolve this rule even further, right? Where we can say, perhaps not only do we want to look at whether or not wallet A is a transit address, but if we can create a rule to detect that funds are coming from not just one transit address, but 2 transit addresses in a series of a short period of time, then again, it builds an even more obvious case that, hey, funds are coming from somebody who's potentially money laundering. And we can very easily do that by combining 2 different rules, where one rule looks at if the address itself is a transit wallet, as well as combining with another rule that says, did that address receive funds from an address that could be a potential transit wallet, right? And again, there's no limit to how users of the platform can create different combination of rules in order to build more effective and accurate detection models. So to kind of round up my presentation shortly, because I know there's been a lot of questions that's come in and I want to make sure that we leave enough time to answer them. Traditional transaction monitoring suffers from the fact that the data available to compliance officers and analytic companies are limited, right? Traditional transaction monitoring, oftentimes you can only see who the sender is, who the receiver is, and the dollar amount in question. Today, with the use of blockchain, organizations which are tracking token movements, CBDCs, stable coins now have access to so much more data in order to enhance their source of funds analysis, where they can go beyond just the direct counterparties in order to see who sent fund to them behind direct counterparty. And how blockchain monitoring has evolved today is not only can we look at all the wallets across multiple hubs in order to identify source of funds, but we can overlay this with a behavior analytic rule engine that can more accurately filter out wallets that may not be relevant. And so blockchain monitoring V3 is going to look precisely like that, right? It's going to be a combination of both approaches, where there will be the ability for users to not just see how these funds are moving, but accurately apply filters in order to narrow down the scope of their investigation or analysis in order to more accurately identify illicit activity. And again, this is an approach that is not limited to just the Bitcoin blockchain, but it's a blockchain agnostic approach. So with that, I just wanted to end off by sharing a little bit more about Merkle Science. So Merkle Science, we are a New York headquartered company, but we actually originated out of Singapore, and we have offices as well in London and in Bangalore. And we're very proud to say that despite only being around for 4 years, we've managed to attract investment from a number of notable crypto and traditional VCs, as well as even SG Innovate, which is Singapore's very own government deep tech-backed fund. As well as, we're very proud to be a part of various associations where we contribute actively to building a safer cryptocurrency and blockchain ecosystem. So with that, I come to the end of my presentation. That's not to say that I'll be disappearing, but we'll be moving over to the Q&A, and I can already see, all these different questions that come in. So I'll leave it to, I believe, Anastasia to moderate these questions. And I'll be happy to answer them as they come up.
Well, thank you, Ian, for such a brilliant presentation. I think particularly when looking at the operational components of tracking and tracing in blockchain, there are a lot of, oh, well, blockchain's transparent. So, it's super useful, and not enough detail and information about what that really looks like. So thank you for taking us through that and showing us sort of under the bonnet what blockchain analytics can really achieve. I'm really interested in a lot of this conversation because, as we've seen, like you say, regulators and policymakers are really focused on the prevention of illicit activity. And yet there is still, by comparison to the traditional finance space, we're in a much better position to trace a lot of those funds. When it comes to tracking value flows through mixers such as Tornado Cash, are these mixers effective not effective at disclosing the source of input of funds? Or when we look at how illicit actors, people who have the wrong intentions, will always stay 2 steps ahead of whatever we have and stay sophisticated. What are the things that you guys are looking at from that perspective, and what's the advice here?
So first of all, I want to point out that you couldn't be more right. Criminals are usually always at least 1 or 2 steps ahead. And if you think about it, it makes a lot of sense, right? Because at the end of the day, blockchain analytic firms, compliance officers, they're incentivized to do their job so that they get paid. But these criminals are incentivized to stay ahead of the game because they don't want to go to jail, right? So purely from an incentive perspective, we can tell who's working harder, right? Definitely the criminals. Now to your question and to the topic of mixers and tumblers, mixers and tumblers are a huge problem in the cryptocurrency industry today because they are a very popular way for criminals to launder their funds. Now, for the benefit of those on the call who are less familiar with what a mixer and tumbler is, a mixer and tumbler is basically a service provider whose job is to obfuscate the source of funds by its clients, right? And the way that these mixers typically operate is that, they would take funds in from all kinds of different people. They will jumble it up and mix it together before redistributing it to the network. And this obviously causes huge challenges for law enforcement and blockchain analytic firms because when these funds go into these mixers, it can be very, very time consuming in order to de-anonymize, right, the transaction flows. That's not to say that it's impossible, but it is very, very time consuming, as well as, depending on which mixer and tumbler the criminal chooses to use, the difficulty can also range.
I'm so sorry, I'm on mute, which is, you know, three years of using Zoom throughout the pandemic, and here we are. I think it's such an interesting point because, you know, as you say, we're looking at the different components of this. Do you feel that when we talk about crime in crypto, that we are talking about different types of crime to, you know, say the rest of the financial space? We have one question here that says, you know, which coins and tokens do you see crypto crimes involving? But is that also the case that actually we're looking at a different type of crime?
So that's a very interesting question. And I want to break it into two parts. First of all, I would say criminals target all tokens. Okay. And the reason I say that is because oftentimes, you know, these criminals, they would target these projects, you know, these DeFi projects, which are built by, you know, developers who have no training in security and compliance. And so there's a lot of loopholes and, you know, software vulnerabilities that they can exploit. And so when they exploit this, they will definitely just steal whatever native token they can lay their hands on. However, once they've misappropriate that asset, it is very common for these criminals to then convert it into either Bitcoin or Ethereum. And the reason for this is because, you know, these are two very popular and highly liquid tokens that they can easily cash out at different points. Now, on top of just the Bitcoin and Ethereum, you know, it's also very common for criminals to turn to things like privacy coins, right? Zcash, Monero, as a way for them to transact anonymously. However, the difficulty that sometimes they face, though, is that, you know, these privacy tokens aren't as liquid. So if, as you can imagine, you know, if a criminal steals $600 million worth of cryptocurrencies, they're going to find it very difficult to convert it into, you know, one of those illiquid privacy tokens, because trying to sell that will literally just crash the market for that token. Yeah.
It's a bit of the sort of catch there, and I think interesting to see how this evolves, because what you talked about there with privacy tokens is someone's put in a really fantastic question, which is one of my favorite topics, which is, where is the line between the transparency and the analytics, which is super brilliant for stopping crime, and then actually crossing the line and it being a breach of privacy? And here's what I'd love to know from your perspective. What does the crypto space offer? What does Web3 offer in terms of finding a compromise between the two? And are we looking at a different dynamic? Because up until now, you know, everyone talks about cash being private. That's not actually a design feature. That wasn't because we put it in, we thought, you know what we were going to do? We want to make every transaction here private. It's just that it happened to be there as in the tools that we have. There's nothing else we could do. Now we've got the option. We can build it as totally private, or we can build it as very open. But what are we seeing in Web3 in terms of finding the compromise between the two and enabling regulators to find the illicit activity without breaching privacy?
Such a difficult question. But it's a question and it's a debate that the industry has been tackling right from day one, right? So, you know, it's unsurprising actually that shortly after the invention of Bitcoin, you know, one of the first few tokens that were created was a privacy coin, right? Because as you can imagine, you know, a lot of the crypto natives, at least in the early days, were people who had huge distrust for the government, right? And so they hated the idea that their transactions could be tracked. Now, in reality, though, the world that we live in doesn't promote people transacting anonymously, right? If we look at, you know, the way that our banking system were designed, you know, with the implementation of the SWIFT system, right? That means that whenever banks are transacting, they need to exchange information who the sender and receiver is. So it's always been this expectation that, you know, as much as we want to respect people's privacy, the need to deter crime and the need to prevent money laundering and to identify these bad actors outweigh individual privacy. Now, whether or not I agree, you agree with that, it's the government stance, right? And it's quite interesting to see then how governments treat privacy tokens, right? Because I think by and large, governments realize that, you know, because of the decentralized nature of blockchain, they cannot shut it down, right? So if they want to discourage the use of privacy tokens, it has to come about through regulation. And we actually see that today. Most jurisdictions in their regulatory framework would very clearly highlight that privacy tokens are deemed as a higher risk asset class, which means that cryptocurrency businesses that want to onboard those will be subject to higher scrutiny or will be required to impose, smaller trading limits, withdrawal limits on these privacy tokens in order to mitigate risk. At the same time, we also see certain regulators take a more draconian measure where they outright say we ban privacy tokens because there is no way to monitor how these transactions are happening. And so we're just not going to allow it to take place in our jurisdiction at all. So I think it's quite telling, the way that they approach this, that we can see how regulators treat privacy tokens. But I can tell you at the same time, there is a huge following of people in the crypto space who strongly believe that privacy tokens are the way to go. And, they oftentimes draw parallels to cash, right? The fact that, hey, we can track cash payments, but we still let it happen.
Yeah, and of course, there's a different risk profile. And I think it's an interesting question of, exactly what you touched upon there. That social contract of we do disclose information. My name is public, and actually, from the perspective of healthcare, from the perspective of government, and what that allows me to do is opt into the protections of the state. All of the foundational level there is that you trust the state.
I want to jump in as well as to make an interesting observation, which I always found super fascinating, which is that, so the last part of the question that Mohit has was that, would this force people to adopt mixers in general? Well, very interestingly, I learned that, in the US, they recognize that not everybody who use mixers and tumblers are criminals. So in fact, if you are running a mixer and tumbler in the US, you can apply for a license to operate it, which means that you have to conduct KYC on all your clients. But what that means is that anybody using it would have their transactions masked by people looking on the blockchain. But in the event that law enforcement requires that information, they could then go to that regulated mixer and say, hey, give me the name of your client. So that could be one way to, balance, what the private sector wants, what the government wants, with as well as restricting what people can see on the blockchain.
Absolutely. And, I think there are loads of other solutions that are being developed by industry leaders who see the huge opportunity and benefits, particularly in the DeFi space or, across the board, but who are really keen to make sure that this isn't just a space for people to launder money. So creating, non-fungible tokens that act as your identifier in your wallet, such as, Burrata, for example. And, what are the other ways around identifying this activity and therefore being able to trace those who are actually carrying out suspicious activity versus just across the board transparency. So it's a really interesting question. And from that perspective, actually, another thing that we've touched upon here is the debate going on that is going to require not just industry, but governments. And we've had quite a few questions today that revolve around jurisdictions and sort of on an international scale. And I'd be really interested to know your thoughts about how we're coordinating around this, what the regulatory landscape is looking like from the perspective of which jurisdictions are working together to find that solution, given that the FATF was set up with an international perspective anyway, even pre taking a look at crypto assets.
So you pointed out a problem that the industry really suffers from, which is that there isn't a harmonious approach to crypto regulation. And this is a very, very big problem, especially, as we all understand how cryptocurrency operates, which means that, blockchains are not run by a centralized entity, as well as blockchain transactions happen automatically, right? If I wanted to send you a Bitcoin transaction, all I need to do is open up my wallet, which literally just requires me to have an internet connection, right? And I can send you Bitcoin from anywhere I want, right? And so oftentimes, when I run courses with some of my students, the best example that I give them is, if I'm in Singapore today and I wanted to send one Bitcoin and then I wanted to send $1 million to North Korea, it's impossible, right? There's just no way I could do that. But with the invention of Bitcoin, I can very easily do that, right? Doesn't matter where the recipient is. All I need is his wallet account, and I can send him as much cryptocurrency as I want from any part of the world. And it's precisely because of the inherent cross-border nature of cryptocurrency that causes regulators a lot of concern, right? Because the fact that it is not controlled by a centralized entity means that there's no organization that they can impose sanctions on, that they can instruct to freeze an account, as well as because of the nature of the blockchain and the fact that they can't shut it down. What it also means is that a lot of cryptocurrency businesses have resorted to what we call regulatory arbitrage, where they simply move their headquarters into jurisdictions which have weaker regulatory frameworks. And now the FATF has done a very good job in trying to create some kind of harmonious standards globally. But the problem with the FATF is that at the end of the day, the FATF is an international body, and what they say isn't directly applicable to me and you, right? At the end of the day, I'm still a Singapore citizen. I only care about what my government says, not what FATF says. And so whenever FATF comes up with a new piece of guidance, a new piece of regulation, it is then subject to all its member countries to interpret that and come up with, their own version of it. And the reality is today, all these not all these countries, that's overgeneralizing, but a lot of these countries have different interpretations as to how they should transpose what FATF wants into their local law. And the best example can be seen with, the FATF trying to introduce something called the travel rule into this space, where, they tried to introduce it as far back as 2019, but today, because, there wasn't sufficient guidance as to how countries to implement it, what we see is a scattering of different approaches by different governments, which leads to crypto businesses really just jumping from jurisdiction to jurisdiction, right, in an effort to, try and escape the need to comply with travel rule for as long as possible.
And it's a really interesting point, because we've been talking about the sunrise problem of, different jurisdictions implementing the travel rule at different times, the need to accelerate that, and also the need to work with industry to ensure that, as they look very different across different jurisdictions, that this doesn't become either a place for regulatory arbitrage or just something that is too difficult for industry to keep up with. But from the last few months, there's been a lot of focus on this, given the new global, and targeted sanctions on Russia with regards to the invasion of Ukraine. But as you say, obviously this has existed. Sanctions have been important previously. I noticed that, obviously you mentioned that it is possible to send money to someone with a wallet based in North Korea. However, a lot of crypto firms are currently regulated as MSBs, as money service businesses at this point, and working very hard to make sure that their platforms are not misused for sanctions evasion. Is that something that Merkle Science has been, working on as well, from the perspective of the analytics? And tell us a bit more about the work that you've been doing in different jurisdictions for this.
Oh, 100%. When the situation with Russia happened, Merkle Science immediately did two things. The first thing that we did was we actually built a dashboard to track donations in cryptocurrencies to Ukraine, right? So, as much as we say that, cryptocurrency is bad because it allows people to evade borders, I want to also highlight the fact that it can be used for good, right? Because there are a lot of third world countries, or a lot of countries that are suffering from political unrest, where it can be very difficult from, the rest of the world who want to donate money to help those causes transfer money in, right? Because the governments may not allow external funds to come in. And so with the Russia and Ukraine situation, what the cryptocurrency and blockchain industry did was that they actually created, these donation funds where anybody around the world could deposit cryptocurrency in order to fund, the Ukraine efforts. And Merkle actually built a dashboard to allow people to see those donations in real time as they came in. The other thing that we did was, recognizing that, Russia was going to be sanctioned, we immediately went and started tagging all the different cryptocurrency businesses which we knew had links to Russia, right? So that, our clients could prevent deposits and withdrawals going to those different entities. Now, the tricky part though comes in is when we deal with private wallets, right? Because with private wallets, there's really no way to say where that private wallet is based, especially because, I can log in with my private wallet today in Singapore. Next week I'll be in SF. I'm going to log in from SF. So where's the private wallet base? So as great as blockchain analytics is, oftentimes we must recognize that simply relying on on-chain information has its limitations. And oftentimes we need to combine this with what we call off-chain data in order to build more effective analytic models.
What a brilliant answer, and thank you so much for sharing. Your brilliant input with Ukraine, the situation in Ukraine. I really love to see all the work that Merkle Science is doing there, and we're really fans. We are out of time. In fact, we've gone over time, and my apologies. Thank you so much to everyone who's joined us as an attendee and for your fantastic questions. Ian, thank you so much for joining and for giving us such great insights onto blockchain analytics. And thank you very much, everyone. We will see you soon again for another webinar very soon. Thank you.
My pleasure. And for those of you who had questions that I was unable to answer, feel free to email me those questions if you want, and I'll be happy to spend some time over the weekend getting back to you guys. Yeah. And once again, thank you GBBC for having us, and thank you Anastasia for a wonderful moderation. Yeah.
Thank you.